The global economy looks set to move beyond its post-crisis torpor and should continue picking up steam provided major risks do not materialize. The central scenario in the latest economic outlook sees global growth of 3.6% in 2014 and 3.9% in 2015. Growth prospects remain strongest in the emerging economies and weakest in Europe. China, India, and Indonesia are all growing above 5% annually. Emerging OECD members like Chile, Turkey, Mexico, Korea, and Israel are also in the fast growth group. Other OECD members like New Zealand, Norway, the United States, Poland, Iceland, Australia, and the United Kingdom should perform well. The slowest growth over the 2014-2015 period will remain in Europe.
The outlook is a bit less positive than it was 6 months ago. Advanced economies will grow at the same rate, and hopefully this will lead to sustained recovery. Emerging economies will have a weaker growth with the exception of China. This could have some negative consequences for the rest of the world.
The wide range of downside risks identified in the outlook signal that the path to recovery is likely to be turbulent. There's a striking slowdown in world trade growth, which in turn reflects weakness in investment, which has resulted in stubbornly high unemployment, particularly in Europe. Tapering of the US Federal Reserve's asset purchases may bring new instability to countries worldwide, while the exit from unconventional monetary policy will be challenging. This could result in a deeper slowdown in the emerging economies, which would have negative feedbacks worldwide. Countries with the tightest trade and financial links to emerging markets would be most affected. A 2% drop in domestic demand growth in all major non-OECD countries, excluding China, would cut growth by nearly 0.9% worldwide, more than 0.5% in Japan, more than 0.4% in the euro area, and at least 0.3% in the United States.
The US must address the fiscal deadlock. They should remove the debt ceiling and introduce a credible medium-term fiscal consolidation program. In Europe, the banking system must be repaired and adjustment and rebalancing should be more symmetric. In Japan, the 3 areas of Abenomics must be fully implemented: monetary policy, fiscal policy, and especially a strong structural reform program to boost growth.